You know, it's a continuum, right? What you've seen with the pandemic is sharply declining cases, hospitalizations, and deaths, and that's great. And you know that should continue. But you know, you also saw in the United Kingdom, which has, I think, at least as high, if not higher, vaccination rates. They've had an outbreak of the Delta variety, and it's causing them to have to react to that. So you're not out of the woods at this point, and it would be premature in my thinking, it would be premature to declare victory. Vaccination has a ways to go to get to levels. It would be good to see it get to a substantially higher level, and you know that can only help. You're right. The statement language is evolving. I would expect it to continue to evolve. There's a lot of judgment in that, but you can expect us to drag our feet a little bit on that because that's what you do with statement language. It's great to see the progress, but again, I would not declare victory yet. I would say it is so great to see the reopening of the economy, though, and to see people out living their lives again. You know, who doesn't want to see that? And it appears to be safe, and I just would encourage people to continue to get vaccinated.
If I could follow up on that, if you view the statement in toto and the dots and the steps as well, do you think this is more a mark-to-market exercise around the improvement in health or around the inflation risks you see developing out there?
I think it's both. No, I think clearly since March, what's happened is people have grown more confident in these very strong outcomes that they'll be achieved. Very strong outcomes in the economy will be achieved. There's more grounds for confidence. We've seen growth come in higher than we expected. We've seen very strong labor demand. We've also seen inflation above target, though, and I think even though you know in our forecasters' case, they do see inflation coming back down over 22 and 23 into areas that are very consistent with our mandate. Nonetheless, the risk is something that can factor into people's thinking about appropriate monetary policy. The thing is, you know, these are 18 different forecasts, and I can't stand here and say exactly what was in all 18 people's minds, but that is something that I think can factor into things as well, factor into our forecasts as well.
Thank you.
Thank you. We'll go to Victoria Guida with Politico.
Hi, Chair Powell. I wanted to ask a little bit more about inflation to make sure I understand how you're thinking about this. So in the projections, inflation is expected to be high this year and then come back down next year, and then maybe start to rise a little bit again, enough for a liftoff in 2023. You know, I know that's obviously, take that with a grain of salt, but that would suggest that you all could theoretically see inflation sustainably staying above 2%. And so I guess my question is, what would be causing that inflation? What would be, because it seems like you all now see a situation in which inflation would be rising in a way that isn't caused by transitory factors in the next couple of years. So would that be the result of a tight labor market? Would that be because this whole situation has raised people's inflation expectations? How are you thinking about that?
So what we're seeing in the near term, again, our base case is that what we're seeing in the near term is principally associated with the reopening of the economy, and not with a tight labor market or tight resource constraints, really. But you're right. When you get to in the forecast, all of that, the supply and demand sides of the economy adapt. We have a very highly adaptive, flexible economy, more so than most. And by 2023. Those increases are really about rising resource utilization, or to put it a different way, low unemployment or high employment is a way to think about it. So that's what that's about. That's about the kind of broad inflationary pressure that results from a really strong expansion, tightening up resource utilization across the whole economy, and lifting up inflation. That's why you would see it then, because by then, in the forecast, and it's just a forecast, they're just individual forecasts. In people's forecasts, that's what's happening.
So the change in the projections reflect the fact that you all are more optimistic about the economic outlook, and not necessarily that you think that this will change the way people think about inflation.
Yeah, I think there may be an element of the latter as well, because inflation expectations have continued to move up. It's all in people's individual thinking, and you can't. It's hard to say. It's not something the committee debates in terms of what the outlook is for 2023. So I'm a little bit speculating, which I shouldn't do, but I wouldn't surprise me if there's an element for some people in seeing the inflation performance that we've had and thinking that I have more confidence that we could see inflation above 2%, that it may not be as hard to do that as we thought, and that inflation expectations may move up to a level. They were really at a level that was kind of a little below 2%. They might move up as a consequence of this, or as a consequence of the new framework. We did see inflation expectations moving up in the wake of the announcement of the framework, but we don't really know that. So ultimately, I think it's consistent with both those things.
Thank you. Now we'll go to Greg Robb at MarketWatch.
Hi, thank you for taking my question. Chair Powell, I'm just looking at the forecast, and the one thing I just don't think it's been talked about all that much is how much the Fed thinks that the economy is going to slow next year. I mean, are we looking at a scenario of a slowing economy next year as with higher inflation? And what do you think about that?
We're looking at an economy that will not have the degree of fiscal support. The fiscal support in the forecasts is much less than it was this year. So, but you've still got a very strong growth, well above the longer run potential output of the economy. You've got growth meaningfully above that, and inflation is lower next year in all of our forecasts. I think the range of core PCE forecasts for next year is 1.7 to 2.5 in 2022 and 2 to 2.3 in 2023. So you're right. You're seeing, I can't remember the number, but it might be in the 3.5% growth for next year. That's a really good year. Coming on the back of a 7% growth year, that's a really good year. That's a year with a lot of momentum. That'll cause significant job creation, and it will. I mean, we would take 3.5%. We didn't have a 3.5% growth year. We didn't have a 3% growth year between the global financial crisis and the end of the expansion. So that would be a good year.
Doesn't it seem like there's a risk of like stagflation, where that you're going to go from 7% and down? That means the economy is really dropping in some way. We haven't seen that, right?
The economy's not the economy is still growing, and growing at a very healthy rate. Our estimate, I mean, different people have different estimates, but broadly speaking, economists think the economy has the potential to grow at around 2% per year. If you're growing above that, then the unemployment rate should be declining. People should be being pulled into the labor force. Wages should be going up. Lots of things should be happening. Businesses should be investing. So, I guess to answer your question a different way, is there a risk that inflation will be higher than we think? Yes. As I said earlier, we don't have any certainty about the timing or the extent of these effects from reopening, and therefore we don't think that we think it's unlikely that they would materially affect the underlying inflation dynamics that the economy's had for a quarter of a century. The underlying forces around the globe that have created those dynamics are intact, and those are aging population, low productivity, globalization, all of those things that we think have really held down inflation. All that's out there still. When we get through this, we'll be facing those same forces. Nonetheless, is there a risk that inflation will remain higher than we thought? Yes, and if we see inflation moving above our goals in a time, to an extent, to a level or persistently enough, we would be prepared to use our tools to address that.
Thank you. Going to Brian Chung with Yahoo.
Powell, Brian Chung, Yahoo Finance. On that point, you talked about maybe some of the more structural changes in that last answer with regards to productivity. I noted that the median projection for R-star, the longer-term interest rate, is still the same at 2.5%, but there's been some literature out there that maybe the COVID crisis could have actually changed some of the underlying fundamentals of the economy and maybe changed productivity, in addition to combine with demographic changes that have already been in effect to suggest that that longer term neutral rate or R star might be higher. What would the implications of that be for monetary policy? Do you think that maybe the Fed could have the possibility of underestimating the long run neutral rate, and what might be the impact of that?
A higher neutral rate would mean that interest rates would run higher by that amount. And that would be a good thing from the standpoint of the economy, because it would give the Fed more room to cut rates. The problem with interest rates being close to the lower bound, of course, is that it really cuts into our ability to react to a downturn, for example, a pandemic. And if you look, for example, at the European Central Bank, their policy rate was well below zero when the pandemic hit. So we don't want to be in a place where we can't react. A higher neutral rate would be, from that narrow standpoint, would be a good thing for us. It would give us more room, and therefore then that would tend to result in better outcomes for the economy over time. You know, you can't estimate it with great precision. I think we would be alert to, studying R star is a whole industry unto itself, and I think we would be alert to factors that might raise R star, the neutral rate of interest, and we'd try to keep up with that, and I think we're all thinking about that and the possibility of that. There are a lot of stories right now that essentially could lead to higher productivity growth and higher R star. We don't know which of those stories will come true, but I'll give you an example. It's just there are a lot of startups, a lot of early stage companies, and is that going to have that effect? We don't know, but we'll be watching those things carefully.
Great. Thank you. For the last question, we'll go to Michael McKee at Bloomberg TV.
Mr. Chairman, of course, you'll be shocked to learn that you have some critics on Wall Street, and I would like to paraphrase a couple of their criticisms and get your reaction to them. One is that the new policy framework is that you react to actual data and do not react to forecasts, yet the actual inflation data is coming in hot, and you're relying on the forecast that it will cool down in order to make policy. I wanted to get your view on how you square that. Another is that you have a long runway, you've said, for tapering with announcements, but if the data keep coming in faster than expected, are you trapped by fear of a taper tantrum from advancing the time period at which you announced a taper? And finally, you've said the Fed knows how to combat inflation, but raising rates also slows the economy. And there's a concern that you might be sacrificing the economy if you wait too long and have to raise rates too quickly.
So that's a few questions there. But so let me say first, I think people misinterpret the framework. I think there's nothing wrong with the framework, and there's nothing in the framework that would in any way interfere with our ability to pursue our goals. That's for starters. All of our discussions and all of our thinking and planning are taking place in the context of our new framework. We're strongly committed to it. We think it's well suited to our goals, including in this unique time. And I think if you look at the forecasts that we written down, our committee is solidly behind them. The forecasts are all consistent with that. Your specific question, I guess, was, will we be behind the curve? And that's not the situation we're facing at all. The situation that we addressed in our statement on longer run goals and monetary policy strategy was a situation in which employment was at very high levels, but inflation was low. And what we said was we wouldn't raise interest rates just because unemployment was low, employment was high, if there was no evidence of inflation or other troubling imbalances. So that's what we said. That is not at all the current situation. In the current situation, we have many millions of people who are unemployed, and we have inflation running well above our target. The question we face with this inflation is nothing to do with our framework. It's a very difficult version of a standard a central banking question, and that is, how do you separate in inflation, how do you separate things that follow from broad upward price pressures from things that really are a function of sort of idiosyncratic factors in a particular, due to particular things? I mean, a classic example was, to pick a narrow example, was the cell phone price war back in 2017, if you remember. There was prices were incredibly low, and it held down core PCE by 0.3 or something for a year, and then it fell out. So this is much bigger than that. And of course, it's not easy to tell in real time which is which, but that's the question you would face under really any framework. And, you know, we're trying to sort that out. I've tried to explain that today about how we think about that. And you know, we do think that these are temporary factors and that they'll wane. We can't be absolutely certain about the timing of that, and we're prepared to use our tools as appropriate. Your second one was, you know, we will taper when we feel that the economy has achieved substantial further progress, and we will communicate very carefully in advance on that, and that's what we're doing. That's what we're going to do, and we will follow through on that. There's no, I mean, we will do what we can to avoid a market reaction, but ultimately, when we achieve our macroeconomic goal, we will taper as appropriate. The third thing was, what was the third thing?
If you raise rates to control inflation, you also slow the economy. And the history of the Fed is that sometimes you go too far.
That's right. And look, I mean, we have to balance the two goals: maximum employment and price stability. Often they do pull in the same direction, of course. But when we raise interest rates to control inflation, there's no question that has an effect on activity, and that's the channel, one of the channels through which we get to inflation. We don't think that we're in a situation like that right now. We think that the economy is recovering from a deep hole, an unusual hole, actually, because it's to do with shutting down the economy. It turns out it's a heck of a lot easier to create demand than it is to bring supply back up to snuff. That's happening all over the world. There's no reason to think that process will last indefinitely. But we're gonna watch carefully to make sure that evolving inflation and our understanding of what's happening is right. And in the meantime, we'll conduct policy appropriately.
Thank you, Mr. Chair.
Thank you very much.
The 16th chairman of the Federal Reserve System, that was extraordinary to see. We welcome all of you on Bloomberg Radio and Bloomberg Television. Romaine Bostick, Lisa Abramowitz with us. We've got some very smart guests to talk about, but we're going to take our time here. I would suggest, Romaine, we extend this out to a 2-hour Fed Decides meeting. I mean, I think, push Weisenthal out and go right through to the tech show coming up. What I would find fascinating, just a one snapshot look here, besides McKee's last question, what is that about? Why does McKee get the last question? Lisa, do we have any idea?
It tends to be difficult. That's all I can say.
There
and
we
it was
go.
The hard question, which is how do you deal with the fact that you're going to slow the growth, even though this is what we are trying to get in the long term?
Let's get to that right now. For radio, the Princes of America, Amazon, doing so well. And Romaine Bostick, to go into the equity market here, what an intraday recovery in Amazon.
Yeah, we saw an interesting collapse here once we got that Fed statement. But of course, once Powell started talking, a lot of people seemed to re-embrace some of the names. Some of them, we should say, Amazon up a percentage, as you can see on your screen, at least for our TV audiences. We should point out some of the other tech stocks like Tesla, Apple also moved back into the green. Microsoft basically unchanged on the day after being down significantly. The bank stocks rallying pretty hard here as well, Tom. So it's a mixed bag here. We're still in the red on the top line indices, but overall, you're starting to see some cherry picking from folks who think they may have a line here on the winners and losers.
Romaine, it was amazing to see it come off. I mean, futures, I don't know what they were down negative, but we've made it, let's say, halfway back here as well. For the close, as you shape up to get us through the afternoon, what will be your key insight?
I think the key insight really here is about accommodation, and I think Powell kind of hit this point here that yes, there is a normalization coming, but there's there's also going to be accommodation along the way here. And I think that's when you started to see a little bit of a perk up here, at least in the equity markets.
Abramowitz says stop with the equity talk. Let's talk what matters here. Lisa, you're looking at the belly of the curve.
Honestly, this is what matters to me. The idea, the sniffing out of a policy error, potential policy error. If you take a look at the flattening of the yield curves, this is the big concern. Look, Mohamed El-Erian agrees with me. He tweeted something out basically saying that the risk of a policy error by the Federal Reserve basically is the main risk right now, barring resurgence in COVID cases. But if you take a look at that 5/10s yield curve, it's contracted dramatically. And if you take a look at the 5/30s yield curve, it plummeted the most since February. You can see the Mohamed El-Erian comment basically saying, this is migrating.
Yeah, but Lisa, with a vengeance, the 2-year came back. Now, for those of you that don't watch us early in the morning, and I do recommend that, it is the pendulum of policy error that we're doing right now.
Look, okay, he's making fun of me for everyone who does not listen or watch in the morning for being gloomy and doomy. The concern being a flattening in the yield curve indicates slowing growth. This is not what the Fed wants to see, and goes to that pesky question that Michael McKee asked at the end, which is, how do you deal with this?
Well, is that what he communicated, slowing growth?
No, he's saying that, look, they've got to balance this.
Yeah. Okay, let's just because of time, I want to bring in Michael McKee here out of the press conference. And Michael, I thought as usual, you were rude as all get out. Craig Torres outdid you, actually. Michael McKee, a quick observation, and then would you please bring in Jeffrey Rosenberg of BlackRock?
Okay. Well, Jeff will probably have more to say about it from a market's point of view, but I took two things out of this. One is that they're moving closer to tapering because, of course, he said this was the meeting to talking about tapering. So we're on the runway now. The question is, how fast does inflation accelerate, and does that move up their timeline? A question I asked, but he did not answer. The other thing is that the Fed is more concerned about inflation at this point. They're still focused on growth. They want to get the unemployment rate down, particularly for minorities and women, but they're starting to worry about inflation being stronger and lasting longer than they anticipated because they've moved up the timing of the rate increases, and they're talking about being on the runway for tapering. I think the Fed is looking at this and going, we have to hedge our bets a little bit here. Let's get a view from Jeff Rosenberg. He's BlackRock's portfolio manager of the Systemic Multi-Strategy Fund, which means he has a very long business card, and he has very long experience in this business. What did you take away, Jeff?
You know, I would kind of call this the mugged by reality meeting. There were three really key big changes that the FOMC was forced to acknowledge by the reality of the reopening. Number one, you know, a big upgrade in terms of the Fed's inflation forecast. Number two, as Powell mentioned, the implication of that forecast is changing the liftoff. And that was the big surprise. Lisa, to your comment about the curve flattening, you know, that's about the market repricing the Fed liftoff, and that hits the 5-year. That's the fulcrum of forward Fed policy expectations. And so that's why you're seeing the 5-year take the biggest increase in interest rates. And then number three is they are now talking about tapering. So the next meetings, it is all about this shift in the market now having to digest that this is a Fed that is no longer willing to look past, you know, tremendous, substantial further progress and being forced to recognize that substantial further progress, and then the market being forced to recognize, what does this mean in terms of no longer having this ever-flowing amount of liquidity? That's the tapering discussion. And then the chair had a difficult time because of the dot plot. He had to address both the tapering discussion and the liftoff discussion. You saw him try to separate those and push off the discussion on liftoff, you know, and that will be the continuing debate here, and those are the key takeaways.
So, Jeff, do you think that the Fed is getting closer to or further away from a policy error? And I ask this in light of the belly of the curve and that flattening in the yield curve that some people, others as well, are viewing as the hints of a potential policy error.
You know, it's a really interesting question because it sort of depends on which error do you think they're making. Because I think the framing of the question on the policy error with regards to flattening is too much, too soon, of tightening. The flip side is that they've been too loose with liquidity and with interest rates for too long. Yeah. The policy error could fall on both sides of the debate. I wouldn't overread into the market move on policy error just yet. Another explanation is just that the 30-year did a lot of heavy lifting. From a valuation perspective, it was more attractively valued than other parts of the curve. And so on the news, it didn't have to move as much as the 5-year did because it's much more vulnerable to the reassessment of that 23 and the surprise of the 2 hikes in the 23, which is really the surprise story out of the dots.
Absolutely, Jeff. And forget the 5-year for a second. Look a little bit longer there. I am curious as to how folks in this market do protect themselves against the possibility that we do see a meaningful rise in rates.
Well, it's difficult. It's really difficult. And I think that's why you saw the initial kind of headline red numbers across the markets, as you were talking about in the initial reaction, just where is there anything? A little bit in banks, seeing some positive, but there's not much. And that's because the markets have become so used to and dependent on a low rate trajectory, ample amounts of liquidity. And today was about, we may have a little bit less liquidity and we may have a faster removal of rate trajectory. So there's a real valuation vulnerability. So there's not a lot of places to hide without taking very big directional bets on real interest rates, on curves. You can do that, and certainly that is a way to remove that exposure. But it's a very big directional bet on that expression of higher rates.
Jeffrey Rosenberg, just never enough time. Thank you so much with BlackRock. Important news there as everyone resets here. We had a 4 standard deviation move in the 2-year yield. We've come back nicely from that as we've seen the equity markets recover as well. There was buried in the middle of the press conference a question on the actual American economy that seems to matter. With ADP and their chief economist, Nella Richardson, lets us finish strong today. Nella, what is your view for Q3 and Q4? I'm asking for Jerome in Washington. What's the outlook for Q3, Q4?
The outlook looks a lot clearer, actually, the more we get through the summer, because when you think about what the dislocations are in the labor market, some of them are very temporary. The idea that there isn't a lot of affordable childcare that is preventing women from going back into the workplace, this mismatch that we're seeing from employers and what they're demanding and the skills that are currently available in the market, we think that some of that, not all of it, and I wish Chair Powell would have said more about the structural implications of the pandemic on the labor market. But some of them are transitory and will leave over the summer when schools and daycares and elder care facilities are completely back up and running to full capacity, when some folks move off of the expanded employment benefits, when health concerns start to ebb. I think you're going to know more certainty about this momentum that Chair Powell referenced growing in the labor market. That hits around the fall. The summer, I think, is still a bit of an uncertain timeline.
I'm wondering if there's any reason to believe that the labor market may have changed under the pandemic and that we will not see as many people come back into the labor force. The chairman mentioned retirements, but also people who may have gone on disability or who've just dropped out of the labor force, and that the Fed will find it much harder to get back to that target they're trying to reach.
I think, Mike, that is the critical question. Remember the job burdens, where they fell. They fell on low-pay workers that had vulnerable jobs to begin with. And now Fed policy hinges on those same vulnerable jobs coming back into the market. That's not a good place to rest your mandate. The mandate should lead to the future where we start reskilling and retooling folks for the jobs that have been created by the pandemic. Look at us now. We are now tech-enabled. We have a digitally savvy consumer. Their purchases are going online. We're talking about a workplace that is more virtual, remote, and flexible than it's ever been before, and yet we're still focused on the same skill set and returning that skill set to the market. So I do think there's been some structural changes. There are some sectors and areas that aren't going to come back in the same way, retail being one, office support being another. I could go on. So really, we need to be sensitive to the fact that we're not going back to normal in the same way, and the jobs market is reflecting that.
Now, one thing that Fed Chair Powell kept repeating was humility. We keep hearing this. This is an unprecedented time. We are in uncharted territories. It is hard to know and understand the balance of risks. Do you think that the Fed's assessment of the risks, the fact that they do appear more concerned about the inflationary impulse and look willing to perhaps slow growth to fight that, is the correct assessment?
You know, Powell's in a tough spot. It's easier to communicate when things are really bad, and it's easier to communicate when things are really good. But when you have this disconnect between the economic growth and what we're seeing in dislocations in the jobs market, and you add on to that pockets of an inflation, you have a really tough narrative to sell. And I think those risks are apparent. I do agree that they are transitory, but the risks are still there. And what I wish we'd hear more of is the limits of data and models in this unprecedented time. At the end of the day, it's about judgment and credibility, and the Fed staying independent and not being swayed by market reaction, which is light, but I think quite sensitive to data going forward.
Naila Richardson, thank you so much. Naila, thank you so much. Greatly appreciate it with ADP. We're going to finish out here and bring the heritage of all that we see here back to all of our Fed coverage. And I really go back to a meeting with Alan Meltzer and David Malpass in the heart of the crash of 2007. Michael McKee, Craig Torres was on fire today. Romaine Bostic and Lisa Bramwitz with us. So Michael McKee, Craig Torres was on fire today. And it harkened back to the age-old discussion wrapped around John Taylor of Stanford, you know it as well as I do, about the idea, the chutzpah of targeting inflation. That got Powell a bit unsettled, didn't it?
Well, the idea of targeting inflation was controversial. It became mainstream, and now it's a little bit more controversial because of the fact that the Fed is trying to hit 2% on average, as opposed to having that be a ceiling. And people are wondering, if you get above it, can you get back below it? So that's going to be an ongoing issue.
Yeah.
I think what the Fed is saying to us now is that with inflation where it is, we will probably know by the end of the year that we are above the 2% average we're looking for.
Mike, I lost a bet this afternoon. I got to buy you a martini because, to be perfectly honest, I really thought you wouldn't go last again. Lisa, let's wrap up with the thoughts. What a stunning move in the 2-year yield. I mean, 4 standard deviations.
Yeah, basically, the market's surprised by the hawkish tilt.
Yeah.
The question, though, from the press conference is, how hawkish are all of the members collectively? Or is this a couple of outliers with Jay Powell and the others on the other side remaining as dovish as they can be? He sounded gloomy, and the market got comfort from that.
Romaine, the NASDAQ, I sold out everything at 2 o'clock, and I've just been hammered.
Well, you have a knack for timing, Tom, but it did manage to sort of squeak back into the green here. Still in the red now on the day, but I think the idea here that we came off those lows, it shows you that there are people out there who still see a lot of positivity here. And more importantly, Tom, that plane is on the runway, but it's not going anywhere for any time soon.
Well, that's certainly the message that we got. This has been absolutely wonderful, particularly Michael McKee. Thank you for your guidance here on this Fed meeting. We particularly thank Priya Misra and David Blanchflower of Dartmouth and TD Securities for their perspective wrapped around the president's final press conference in Geneva. He is on Air Force One on his way home. We're going to go to the close. We're going to get through the afternoon. Maybe the technology show will consider Amazon surging a negative 224 on the Dow. On Bloomberg Radio and Bloomberg Television, this sets us up for an eventful week. Tomorrow at 8:30, if McKee shows up and darkens the door, we may consider jobless claims. Thanks to our team, the Fed decides.
And you have been listening to our Fed coverage on Bloomberg Radio and Bloomberg Television. Of course, the Fed decides. The Federal Reserve officials signaling that the pace of the U.S. economic recovery from the pandemic is bringing forward their expectations for how quickly they will reduce policy support. 13 of 18 officials seeing at least one rate hike in 2023. FOMC upgrading those inflation projections for the next 3 years. We have seen swift market reaction. So we're going to continue our coverage right here on on Bloomberg Business Week. I'm Carol Masser in our Interactive Brokers studio. Let's get a check once again on that market day and on some of your top stories. Here is Charlie Pellet.
Thank you very much, Carol Masser. Right to the numbers. S&P down 16 now, drop of 0.4%. Dow Industrials down 224, a drop right now of 0.7%. NASDAQ lower by 13, down 0.1%. NASDAQ 100 down 0.2%. 10-year yield right now 1.56%. Bond yields jumped after Fed officials signal they will begin dialing back the stimulus that has fueled the recovery from the pandemic. You heard Fed Chair Jay Powell live right here on Bloomberg Radio.
Today, the Federal Open Market Committee kept interest rates near zero and maintained our asset purchases. These measures, along with our strong guidance on interest rates and on our balance sheet, will ensure that monetary policy will continue to deliver powerful support to the economy until the recovery is complete.
So it is a down day. Stocks, though, did pair earlier losses after Powell downplayed the risk of an immediate rate increase. The quarterly projections show 13 of 18 officials favored at least one rate increase by the end of 2023 versus 7 in March. Gold is down 1.4%, $18.33 the ounce. Bitcoin down 3.1%, 38,707 right now. West Texas Intermediate crude oil lower now by just about 0.3%, down 18 cents a barrel, 71.94 on WTI. So again, recapping, 10-year yield 1.56%, S&P down 15, a drop right now of 0.4%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. So it is a Fed Wednesday, and we know the Fed, of course, kept rates unchanged. They are continuing their asset purchase of $120 billion per month. But again, as expected, bringing forward that dot plot. And we've definitely seen reaction, as Charlie just mentioned, in the financial markets. Let's talk about it, though, with Doug Sioka, who has seen a lot of Fed meetings and a lot of cycles. Doug Sioka is CEO and partner at Kavar Capital Partners, and they've got roughly $970 million in assets under management. He's with us once again from Leawood, Kansas. Hey, Doug, nice to have you back with us on this Fed Wednesday. How do you read this report?
Yeah, thank you for having me back. I mean, I don't know that a lot of the language was, or the press conference answers were all that surprising, Carol. I mean, I think the Fed still has near unanimity, right, on the prospects of patience. And they've been given cover lately when you get a kind of a weaker retail sales print yesterday, and we've not had that huge non-farm payroll print that seemingly everyone has anticipated. So, I think it was logical to see some of the dots rise of the beloved dot plot, given some of the hot inflation points since the last meeting. But the increase in rates is about inflation, yes. Growth, yes. Or I think that there's collectively elevated increase in GDP projection by 0.5% this year. But the unemployment forecasts haven't really changed, and I generally don't think the dots are as meaningful as policy. They're not policy, nor are they an average of a projection of policy. So I didn't find a lot from the meeting to be all that substantive or surprising.
Well, and I feel like going through and parsing through all the headlines, I mean, it definitely did feel like a little bit of a jolt, especially to hear some talk and conversations about interest rates maybe sooner rather than later. But we knew ultimately they were going to raise. He also talked about the Fed chief about being accommodative still for a long time. And he is going to watch that employment rate and is willing to let inflation go a little hot to get to that point where we get back to getting Americans back to work.
Yeah, I think he underscored very well and thoroughly that the recovery is, as he called it, incomplete. Right, unemployment is still 5.8%. So why we would be in a rush to tighten, I'm not sure. But you also have to understand the context of the recovery and the extrication of stimulus. The Fed is only one half of the story, and the Treasury/Congress is equally as important, particularly as it relates to the inflationary influences being anything but transitory, if that makes sense.
Well, what does that mean then as investors? So you're right. It's not just the Fed that has, pumped a lot into this economy to get it to where it is at this point. So as investors, I don't know, how do we read that?
Yes, so I think so you think about it as the Fed and Treasury, which helped us get through the depths of the pandemic, economically and from the standpoint of the markets. They were very coordinated in their policy posture. And they must stay coordinated in their stances. They remove some of the stimulus, right? Disharmony in the part of the Fed and the Treasury will be far more devastating to markets than a taper, right? Because the taper, if you think about it, would be the result of effective fiscal policy. The Fed would only taper that felt the economy could handle it. The economy can handle it in large part from the stimulus which bridged the production gap as the world went through COVID. So better to take a combination out of a robust economy where volume is playing well with margin, and when the strength, then when to do that when it is strong, then when the strength begins to dissipate. And yes, I mean inflation is a byproduct of that strength, but it can still be beneficial at this point of the cycle if it is indeed transitory. And I think this is important.
Well, go ahead, because that's where I was going to take you. I mean, it's safe to say at this point, Doug, that we are still dealing with data points that have been impacted by the pandemic, and we're still bouncing back from those significant lows. Until we kind of get purer data, we don't really have a true assessment of the economy.
I would agree. And I would think one of the things that it's surprised investors is the continued strength of the stock market coming out of such a strong fourth quarter of last year and first quarter of this year was because we hadn't even fully priced in the massive amount of earnings growth that was the function of the economy reopening, right? And the Fed is taking most of the criticism, but it really needs to be shared going back equally on the fiscal policymakers, because the inflation that's a byproduct of the strength can be beneficial if companies still have the ability to pass along higher input costs. If it invites competition that benefits the end buyer. And consider that inflation is actually a contribution to total market returns over history anyway.
Right.
But when inflation becomes problematic, Carol, as it turns out not to be transitory, because fiscal policy overstays its welcome once monetary policy begins to leave the party.
But again, we don't know.
It's like, that's going to create confusion.
It's like Uber, right? Like when you need a car and all of a sudden it starts to rain and the prices get really expensive. And then all of a sudden more cars, I mean, this is how the model's supposed to work, more cars come on and then the price goes down. I mean, if indeed we see some of these supply chain bottlenecks or these, price increases for commodities and so on and so forth. We've seen copper, lumber already start to come down. We know Powell talked about that a little bit, I think lumber specifically. But I mean, until we know, again, as you said, transitory or not, it's hard to know what the true picture is of inflation.
Oh, I think that's right. But I think one of the ways that you do it is in the absence of an exactitude in the ongoing science experiment is you have to do it piecemeal, and you have to do it within a laboratory that is still conducive to the underlying economic growth. And we've been harping on this point for a while, but the retention of a high velocity of money is so important as we realign fiscal and monetary policy so we can reset an appropriate base case. And it's the velocity of money that catalyzes economic growth, which offers cover for this subtle pivoting, as long as the implementation of the extraction is not combined with what we call unnatural impediments, right? So what's an unnatural impediment? Higher capital gains taxes at the inception of a very delicate point of the recovery. Legislation that's done by reconciliation as opposed to actual compromise and constructive collaboration. Trade policy malignment. Those are the kind of things that will convolute the outcome of the experiment and muddle the base case, which just means it'll be more guessing into the future and probably instigate more volatility.
All right, so what do we do as an investor? Bottom line.
I mean, bottom line is if you consider where we are, both equity and fixed income, right? One of the broader implications and challenges that face anyone that is investing money right now is this whole traditional and classic 60-40 model under assault. Right? Obvious challenges in fixed income markets producing anywhere near the returns they did in the last 15 years for the next 15 years. Right? Just a zero mathematical bound alone keeps a responsible lid on expectations. So you have to look outside of conventional fixed income right now. What's that? Floating rates, private credit, convertibles, emerging market debt, things that have better risk-adjusted potential with positive real yields. And then within equity, we think four things, right? Active management in equity, both domestically, and then the second thing, branching out to more foreign countries that have not yet participated to the extent of the economic recovery that we have here. And I think you have to be in specific companies that are economically not interest rate sensitive, those that have pricing power and broad competitive advantages. And finally, weave in subtle inflation hedges, right? Companies and countries that benefit from a weaker U.S. dollar emerging markets, financial services companies on foreign and domestic shores. And then I said floating rate debt and EM and frontier market debt, but also multinational companies, because it gets the benefit of currency conversions in a weak dollar environment with a large and continuing to grow global economy.
Hey, listen, do you think, like some others, that we are going to see some kind of, at least on the equity side of things, a market correction in the second half of the year, just because we've gotten ahead of ourselves?
Highly possible. I mean, right now, what we've had, 4.5% drawdown for the year to date in almost 6 months, and typically we would expect about a 13 or 14% average annual drawdown. So I think it'd be highly possible that we do. And if we do, I think that could be very beneficial, right? It almost seems blasphemous or treasonous to want the stock market to correct, but
I like it when some of the fluff is taken out, to be quite honest.
Absolutely, we agree. Valuations in check are important.
All right, Doug, good to get you, especially on this Fed day, and get your insight. Doug Sioka, he's CEO and partner at Kavar Capital Partners. They've got roughly $970 million in assets under management. Doug joining us on the phone from Leawood, Kansas. Just a reminder, big day, Fed officials signaling that the pace of the U.S. economic recovery from the pandemic is bringing forward their expectations for how quickly they will reduce policy support, but they are still being very accommodative, and we certainly saw that in leaving rates unchanged, maybe seeing 2 rate hikes by the end of 2023 and inching towards a tapering. What does that mean? The S&P is down about 22 points, Dow down 268 points, and the NASDAQ a decline of about 31. We are bouncing off our lows. It is time right now for Beyond the Close with our team over at Bloomberg TV on this Wednesday.
Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic, Caroline Hyde, Taylor Riggs counting you down to the close, here to help take us beyond the bell. Our global simulcast team, Carol Massar, bringing together our Bloomberg television, radio, and YouTube audiences. Carol, such a wild day. I guess Tim had to take it off.
He did. He likes to take those Fed days off and just kind of relish in all of the information. What a day. We're bouncing off our lows on the equity side of the markets. Those were significant moves, certainly on the Treasury side of things. We got a little bit of everything, I feel like, in this report. Bottom line, I heard you, Romaine, earlier on Bloomberg TV and Bloomberg Radio on our Fed coverage. I mean, the Fed is going to be accommodative. They're going to still watch the labor market. It's got a long way to go.
And I think this is an important point here, too. I mean, yes, they are trying to normalize, but we talked about this analogy that the plane is on the runway, but it's really not going anywhere anytime soon.
And it's also a lot about trying to fight the dot plot, that so-called dot plot, that viewpoint coming from the rest of the 17 members of the Monetary Policy Committee. Of course, Fed Chair Powell, I think, seems to be the most dovish amongst them to a certain extent. There are some more hawkish rumblings, but he's definitely trying to say, like, take it with a pinch of salt, hey, Taylor.
Yeah. I think one of the key moments there is it's not tightening. It's just slowing down the rate of increases on extended easing. And there is a very big distinction in the wording and the language.
And before we get to the equity close here, I mean, we should point out, you talked about, of course, Taylor, that big move that we saw in the belly of the curve. Obviously, a lot of people using that as sort of the basis for when the Fed might take off. But you talk about a huge drop in gold today, down almost 2% here on spot prices, and a huge move higher in the dollar. You look at euro dollar, you look at versus the peso, pretty much everything here, massive strength higher here. Not necessarily massive strength in the equity market. Some of that rebound that we had off the lows getting paired back here, 42.22 on the S&P 500. That's down about 0.5%. The NASDAQ composite down about 0.2% at 14,037. The Dow Jones Industrial Average down about 268 points. That's down about 0.1%. As far as the Russell 2000, small caps, that's actually your relative outperformer here, Carol, only down about 0.2%.
And nowhere to really hide when it came to the equity markets. We saw a little bit in terms of outperformance among the financials. You'd expect that in terms of higher expectations for interest rates, but nonetheless, it was a tough day overall, broadly, Taylor, for the equity markets.
It really was, particularly for our radio audience. If we're taking a look at the sector level, Carol, you really nail it when you talk about the financials. Under so much pressure, we were on one of the worst streaks we had seen since January for the banks, the financial sectors. And yet today, with the move up of 8, 9, 10, 12 basis points higher in yield, it means that banks are up about 0.4%. Only 4 sectors really here in the green, as everything else is on the red. Carol, I know you're going to look at some of the individual individuals, but it's sort of some of the other defensive bond proxies, utilities, food staples. Those were some of the hardest hit sectors today.
All right, so equity hit hard, but I did find some gainers. General Motors among them. That stock up about 1.6% in today's session. They're going all in on the EV race, electric vehicle race, boosting their investment in future technology for a second time in 8 months, planning to spend $35 billion in more than 30 plug-in vehicles by 2025. So they're upping that, boosting that spending by 30%. Centene Corporation, that was an outperformer in the NASDAQ 100, up 3.7% in today's trade. It's the largest seller of Medicaid health plans in the U.S. And stock rallying to a record after giving some forecasts at an investor event. So we saw that move. Dish was a top gainer in the S&P 500 today. Upgraded to buy from hold over at Pivotal Research, which sees significant upside potential from the company's 5G wireless service. So Dish up almost 2.7%. And this one, not a household name, a small cap company. Check it out, everyone. Orphazyme, ORPH is the ticker. ADR spiking. It's based in Copenhagen. I never say it right. It's a biotech company, and this was retail traders kind of playing with this one. It was up about 61% ahead of a key regulatory decision date for its drug with Cytrex.
Well, with all the talk coming out of the Fed, you actually saw a nice boost to a lot of the banking stocks, with one major exception here. Keep an eye on Citigroup, down 3% here on the day. This is the 10th straight day of declines for Citigroup. So all that commentary we got yesterday out of Mark Mason, all that, well, that was certainly a catalyst for today's decline. This has been on a downtrend for a while. This is the longest losing streak right now for Citigroup, going back to December of 2018. They've lost 11% here in the past 10 days. A real kind of a stealth decliner here, something they really keep an eye on as we move forward into a different rate environment. Rate environment might be different here for D.R. Horton and the home builders. They were down hard on the day, and then Roblox and, of course, Oracle also lower here after their quarterly updates. Caroline?
Romaine, I go across asset for our radio audience. I'm going to bring you to global macro movers and paint you a picture of everything down against a strong US dollar. We had the biggest move in the dollar since January, 5-month move. The euro, we've had Citigroup analysts saying, look, get out of that long euro bet because the euro is going lower as the Fed has really become more hawkish than expected. Euro off by 9/10, basically in a full percentage point. Your worst performer, the Norwegian krone, off by almost 2%. Remember, more central banks in play. Tomorrow, we get the Norge banks, who will wait for how they deal in terms of central bank policy. Swiss franc also down significantly against the US dollar. We usually anticipate if we get dollar strength, perhaps a bit of commodity weakness. We are seeing actually wheat pushing back. We've got some of those softer commodities that have seen a significant pullback in recent days, rains and the like, better anticipation in terms of growth. Well, wheat actually now rebounding a little bit from that sell-off. We've seen steel on the downside off by 0.7%. Some of the agricultural products, milk and lean hogs, also on the downside. But this really is a story of what rates are doing. Flashing red, North American, Canada 2-year up by 4 basis points. Australian yields also pushing higher. But really, this is a story of what happened in the US in terms of bonds, Taylor.
It is 100% an ununch kind of day, a hawkish surprise kind of day, a rate of change kind of day when you're up 4, 11, 8. And well, just 1 basis point as we move across the curve. It is the belly of the curve.
How excited did you get when you saw the 5-year move?
I was so excited. I tweeted a photo saying today was my day, Romaine. It is some of the biggest moves. Thank you, Caroline. Since February, really the hawkish surprise, and this really kicks off some of the conversations that we've been having coming into this print. Carol, there was so much rallying, dovishness with the 10-year below 150. All the notes I read said that really set us up for this hawkish surprise, that we had really gotten into positioning, and recently, tactically, banks had turned short on treasuries, and it looks like that indeed does play out today as we've sort of pulled forward, Carol, some of the inflationary growth expectations and perhaps maybe a rate move or two.
And I am curious about what's going to be the 24-hour, 1 day from now, reaction tomorrow as people start to settle in. Because yes, the Fed raised its expectations for what's going to happen this year, but then talked about things settling down in the year after that, 2022. And again, Powell talking about the retreat in lumber, talking about transitory moves in some of these commodities. So do we settle down in the financial markets a little bit when we start to kind of parse through everything that Jay Powell had to say?
It's Taylor's day, but is it a standard deviation kind of day?
Romaine, I feel
it is.
We're talking standard
full
deviation.
standard deviation.
I just got offset with Tom Keene, so we've just been talking about standard deviations for the last 3 hours. You love them. All right. Well, we had a lot of them today, Carol. But just real quickly on the inflation point you were making here, and I think this is key here. We did see the inflation expectations, at least as measured through the break-evens and the swaps, actually come down a little bit. So the buy-in here to the idea that this is transitory does seem to be real by the markets, and I think that's why you saw the reaction, particularly in the 5-year yield, Taylor. And I know, Caroline, I mean, you were complaining about the price of your burrito here, but maybe that could be transitory as well.
Maybe if I'm looking at wheat, suddenly pushing a little bit higher once again, but corn. But the question is how much have we gone too far, too fast? And now we've got the pullback. We've got a buyer's strike. We've got lumber coming down. Perhaps we're starting to see a few cautionary tales within the housing data that we're getting.
This is good.
We've got some of the, perhaps a little bit of data tomorrow, more fast-paced data, high-frequency data, Taylor, in terms of jobs perspective. I mean, it'll be interesting to see whether we still see full pedal to the metal or whether we do start to see the friction continuing in the labor market.
We pull forward to the jobless claims on Thursday, the fast economic data that Caroline mentions, as we have a Federal Reserve, as we have continued to learn today, Carol, that it is about a labor market, even though transitory inflation will take a back foot for now. Quickly here, we push forward to some of the earnings we're getting. Lennar is one that we're waiting for, given housing markets. And Honest Company, we're getting first quarter revenue of $81 million, a first quarter loss on the bottom line of about $4.5 million, a loss per share of about 13 cents. This is, I believe, the first report since they've gone public, Caroline, though you have been following this company much more closely.
Jessica Alba, remember interviewing her a little bit a while ago. It's had a rocky road since it went public. It did very well on its initial first day, revenue 81 million. Remember, diapers, folks, they're getting more expensive. And there I talk about inflation, Carol.
Yeah. Well, exactly. The stock's up about 10% from that IPO back in early May, but it is important. Listen, we remind everybody we're in this kind of netherland of waiting for the next round of earnings when we'll start to get what CEOs have to say about pricing and supply chains and whether it gives us a fuller picture to layer on top of what we got Romaine today from Jay Powell and company.
I think so, and I think it's good you bring up the supply chain issues. I mean, obviously Powell addressed that, but I think some of what he addressed wasn't necessarily what I think some of the companies, at least in the most recent earnings calls, were talking about. There are things that are really outside the bounds of macroeconomic policy, and you wonder whether those things right-size themselves over the next couple of quarters.
Romaine, what I really want to know, I think what everybody wants to know, did you get any sleep today?
Well, no, I'll sleep later tonight, I think.
Okay, good stuff.
There's not a nighttime show, is there?
All right, that's going to do it for this Beyond the Bell coverage on this Fed Wednesday.
Oh, that's so soon.
Yeah, we'll catch you, everybody. Same place, same time tomorrow.
Certainly will.
You're listening to Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
All right, so a little bit of earnings. We mentioned Honest Company just coming out after the closing bell. First quarter adjusted loss of 5 cents a share. And first quarter revenue, 81 million. A little disappointment. We're seeing it down about 2% in the after hours. Really the big news, though, of course, is that Fed decision. And the Fed signaling that the pace of the U.S. economic recovery from the pandemic is bringing forward their expectations for how quickly they will reduce policy support. We expected that dot plot to change. We expected it to be brought forward. But again, the Fed chief giving a lot of caveats before any kind of significant changes in policy. All right, let's get to world and national news. For that, let's head to D.C. and
agreed to reach a level of strategic alliance. Hey, Carol, it's a busy day. President Biden says he and Russian President Vladimir Putin have agreed to reach a level of strategic stability, with diplomats expected to continue the discussions on arms control and cybersecurity. Biden says success will be determined by what happens next.
This is about practical, straightforward, no-nonsense decisions that we have to make or not make. We'll find out within the next 6 months to a year whether or not we actually have a strategic dialogue that matters.
Biden says it was important for him to meet Putin face-to-face and says he did what he came to do. There might soon be a new rule for publicly traded companies to reveal financial risks that they face related to climate change. Bloomberg's Amy Morris with more.
New legislation requires the Securities and Exchange Commission to issue new rules directing businesses to file reports on environmental, social, and governance issues. Businesses would have to reveal the risks they face from extreme weather and greenhouse gas emissions. Republicans say the bill panders to social activists. SEC Chair Gary Gensler says the agency is eyeing its own rules this fall for climate risk disclosures. In Washington, I'm Amy Morris, Bloomberg Radio.
Members of the bipartisan Senate group working on a compromise infrastructure plan say more lawmakers are lining up in support. Republican Ron Portman of Ohio, who's been leading the effort, says he's optimistic they can find sufficient backing to make it a viable plan. The 10 senators involved have yet to release a formal outline of their proposal. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
All right, Nance, thank you so much. Carol Masser in our Interactive Brokers studio. Tim Stenovic off today. Charlie Pellet joining me right now. And Charlie, there's a story about Google opening its first retail store. It's just steps away from Apple in New York City.
Indeed, located in the, I'll call it swanky. It really has gotten swanky over the years, Chelsea neighborhood. But what's interesting about this, Carol, is I looked at this story. I said, Google store, wait, this all sounds very familiar.
Why?
And, well, because Google has had pop-up stores around New York City over the years, specifically one that I looked at down in the Soho neighborhood. But it began, according to our story, it began experimenting with those pop-up stores in 2016. That was the same year that it debuted its Pixel smartphone and Nest smart home speaker. And like the Apple stores, this is a kind of retail experience, and I'm going to emphasize experience, where you go in and the focus is actually touching the stuff, playing with the goods, checking out the merchandise, and they're hoping that if you don't buy today, you will at least know what you're buying so you can come back and get it in the future or order online.
Yep. Store was designed with a social space, sitting areas, tables, other furniture that invites a level of public intimacy and intermingling that has been a rare experience during COVID-19. So the furniture, it's sofas, it's oval-shaped tables. They're made of blonde wood and cork, neutral colors, so the products stand out. Listen, we know it's worked well for Apple, so maybe it works for Google. But ultimately, Charlie, we all know this. Hardware, you got to like the hardware. It's got to be something that consumers want.
Indeed. And what's kind of neat, though, just about the shopping experience, there's a kids' room there, quote, where you can park your children while you're shopping. Also a space where people can use the Pixel phone's night sight feature to take images in the dark and then email photos to yourself. Also a room where 3 people can play video games through Google's Stadia streaming service. I like the idea of a place where you can park the kids. I'm thinking Google, why not a place where you can park your pets, take your dog to the shopping experience?
There's also an imagination space, partially enclosed by a 17-foot tall glass round structure with screens inside. On the screens, visitors can experience advanced or experimental Google services that may not be available to the public yet. This is definitely sounds like an experience. All right, Charlie, thank you so much.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Bond yields jumped. Stocks fell for a second day after Fed officials signaled they will begin dialing back the stimulus that has fueled the recovery from the pandemic. Stocks closed off the lows of the day after Fed Chair Jay Powell downplayed the risk of an immediate rate increase. 10-year yield 1.57%. Stocks lower. S&P down 22, a drop of 0.5%. The Dow down 265, down about 0.8%. Nasdaq tumbled 33, a drop of 0.2%. Again, the 10-year worth repeating 1.57%. Gold down 1.6%. 18.29 the ounce. West Texas Intermediate crude down 0.4%. 71.86 a barrel on WTI. Oracle lower after last night's earnings report. Oracle shares tumbling today by 5.6%. Again, recapping 10-year yield 1.57%. S&P down 22, a drop of 0.5%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thanks so much. So one of the many reasons we love Business Week, it takes us to places, new ideas. This time around, it's a $110 million helmet that aims to mine health secrets from the mind. Let's get into it. Someone who always takes us also to cool new places, ideas, and innovations. Bloomberg Business Week feature writer and New York Times bestselling author Ashley Vance, host of Hello World, author of Elon Musk, Tesla, SpaceX, and the quest for a fantastic future. He's with us from Palo Alto, and also with us is Bloomberg Business Week editor Joel Weber on the Access line in Brooklyn. These are the kind of stories I just learned more and more about. Not only the subjects that Ashley writes about, but about Ashley.
Yeah, and boy, the subject of this one's going to be a fun one to talk about. So Ashley, who are we talking about, and what does this brain scanning helmet that he's developed do?
Yeah, well, there's a guy named Brian Johnson who's kind of the main character of the story. He's not super well known, but he is very rich. He sold a company called Braintree to PayPal for several $100 million a few years ago. And then he took all that money and started this new company called Kernel, which is, like you said, they've built these helmets that can peer through your skull, see all the electrical activity, see all the blood flow, and basically watch your neurons fire in real time. And you know, the big breakthrough really is we have machines that do some of the stuff like fMRI machines and MEGs, things that you would find at a hospital or a research center. And, you know, he's found a way to boil all this down into a helmet that anybody could wear.
So I'm going to put this on, and what's it going to do for me exactly?
You know, I mean, there's a few things going on. His kind of driving thesis is this idea that for mental health, if you went to the doctor and you were worried about your heart, they would run all these tests on you, you know, obviously do some blood work, and we just don't have anything like that for the brain. And so he wants, you know, partly because these things have been expensive and hard to use. We just don't have much data on the brain. And so he wants to make these affordable enough that thousands, tens of thousands, maybe even millions of people would be using these machines to see their brain activity as they go through their day, as they try to recover from an illness like a stroke or Parkinson's disease, and that we would just learn a lot more about how the mind works.
Well, and that's the point, Ashley, right? I mean, we do know a lot about the body. We do know a fair amount about the brain, but there is so much that is unknown. And he thinks about it kind of juxtaposed against artificial intelligence, too.
Yeah, you know, he started this company. I've been following him for a few years. And he really started when he thought that AI was getting so powerful that humans would not stand a chance against it, and that our only hope was to kind of, you know, merge with machines and create this brain-machine interface. It's a way that really you could add computing horsepower to your own brain and vice versa. So that's kind of the root of all this. Over time, Brian, he's an interesting character. He's really into kind of the quantified self movement. He has all these tests done on his body, and he's very particular about how much he sleeps and what he eats and how he exercises and all this stuff. And so, you know, the other part of this is like for him on this personal journey is that he wants to know everything about himself, and the brain was like this last bit that he couldn't measure or understand.
Can we talk about his abs? And maybe your abs? How do your abs compare with his abs?
We are on YouTube. You can show all Ashley right now.
When I started this story, I mean, so Brian and I are almost exactly the same age. We're both, the calendar says we're both 43, about to turn 44, and you know, we probably looked like somewhat similar 3 years ago when I first started talking to him, and I've gone, you know, one way or I've stayed sort of the same, and this guy has gotten totally ripped. I mean, he eats one meal a day at very early in the morning. He eats like 2,300 calories in this one go and picks out all the food, and he does his workout in the morning. And, you know, to the extent you believe in all this stuff, there's different ways you can kind of measure your biological age. And, you know, so he's gone from 43 to the doctors say he's got like the body basically of like a 25-year-old now.
Yeah, okay.
I could go for that.
Forget the helmet. I want that, right?
So how does he has snorted stem cells? Does that help?
You know, so I did. I've seen him snort stem cells before. Yeah, I mean, he goes to this wellness clinic in Colorado, this Grossman Wellness Center, and they like take out some of your blood and they spin it in a centrifuge and get the plasma, and then some kind of magic happens to the plasma that turns it into these stem cells. And the doctor, I saw him do it. He snorted them right up his nose. It's supposed to improve your memory, your kind of attitude, your general disposition and towards life. And he said it worked. He did it quite a few times, although he's stopped doing it now.
The details about him and who he is and his background is pretty incredible. Actually, just got about 25 seconds left here. I mean, a bunch of investors, over 200, passed on investing in him. What's the hope for this? Like, what does this become? Because he's sending it out to what, Harvard, the University of Texas, and other places. Just quickly, 20 seconds here. What could this become?
Yeah, you know, it's going to start out at research centers where people are going to be able to run tons more scans on brains, and then he wants it to become a consumer device, sort of like a Oura Ring or a Fitbit. That's the goal.
What do you think, Joel?
I mean, I'm gonna try and wear it, and I don't know what's gonna happen, but like the journey will be, you know, interesting. Whether or not I snort stem cells, I don't know.
Coming to maybe Bloomberg soon, these helmets. Ashley Vance, great stuff. Joel, thank you so much.
Broadcasting live from the Bloomberg Interactive Brokers Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 1061 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119 and around the globe. The Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
You might remember him from his days back in Studio 54 in Palladium. That was back in the 1970s. He created the Boutique Hotel in the 1980s. He created the Public brand. He's going to tell us exactly what's going on when it comes to hospitality. We're going to talk with Ian Schrager. He's going to be back with us in just a moment. First up, though, back to your top business stories. Another check on that trading day. Back to Charlie Pellet.
All right, thank you very much. Down day on Wall Street. Bond yields jumped. Stocks fell for a second day after Fed officials signaled they will begin dialing back the stimulus that has fueled the recovery from the pandemic. With that story, Bloomberg's Vinny Del Giudice.
Fed officials are once again holding the benchmark U.S. interest rate near zero, but pulling forward the liftoff date. Wrapping up a two-day meeting, they noted America's economy and the labor market are making gains as vaccines reduce the spread of the coronavirus. The central bankers also marked up their inflation forecast through the end of 2023. The Fed cut to zero when COVID-19 flashed across the nation in March 2020. Vinny Del Giudice, Bloomberg Radio.
A reaction to the Fed chair's news conference from Doug Sioka, the CEO of Kavar Capital. He was interviewed right here on Bloomberg Business Week.
I think he underscored very well and thoroughly that the recovery is, as he called it, incomplete. Right? Unemployment is still 5.8%. So why we would be in a rush to tighten, I'm not sure.
And Diane Swunk is chief economist at Grant Thornton. She spoke with our Tom Keene.
We expect to see the economy get back to full employment sometime in late 2022. That still gives us rate hikes in 2023, and that's what the Fed is expecting.
S&P down 22, a drop of 0.5%. Dow Industrials down 265, a drop there of 0.8%. Nasdaq down 33, a drop of 0.2%. 10-year yield now 1.57%. Gold down 2%, 18.21 the ounce. West Texas Intermediate crude down 0.4, 71.83 a barrel. Citigroup lower after CFO Mark Mason signaled revenue from the bank's trading operations will probably fall around 30% from a year ago. Citigroup shares lower today by 3.2%. Moments ago, we heard from home builder Lennar. Second quarter EPS $2.65. Second quarter revenue $6.43 billion. Estimates $6.21 billion. Shares are higher by about 1.5%. I'm Charlie Pellet. That's a Bloomberg Business Flash.
All right, Charlie, appreciate that update. Well, New York City, if you walk around, it definitely is coming back to life in a big way. The U.S. overall increasingly opening, making its way back to a post-pandemic life. The rest of the world we know moving forward, but it's not the same for every place around the globe. We are definitely still, though, in a pandemic. But we know one industry that's been really hard hit is the hospitality industry. And our next guest has been involved in the hospitality industry for 5 decades. Delighted to have back with us. He created the Public brand. It's getting a reboot, and we're going to hear about that in just a moment. Ian Schrager is with us, hotelier and founder and chairman of the Ian Schrager Company, back on the phone in New York City. Ian, so nice to have you here. It's been about a year. How are you?
Very good, thank you, and thank you for having me.
Well, it's nice to have you. So where are we? Things are a lot better than they were a year ago.
Well, things are looking very promising. We just opened up Public last night, and the reservations are booming. The restaurants and bars are really packed already, and I think we're optimistic about business going forward. There are some problems still, but they're good problems to have. Well, demand is there.
Well, that's what. Talk to me, if you can, kind of quantify as best as you can, Ian, the demand that's coming back.
I think people who live in New York City and around the world are ready to go mad, and they're just really looking for a place, a platform to do that. I think in New York in particular, we're in a very funny situation because New York is really completely occupied only by New Yorkers now, because there haven't been many travelers from abroad or from around the country. But I think that all the signs are right. The demand is definitely there. It'll take a little while to ramp up. I can't tell exactly how fast that'll be, but I am confident it will ramp up. Labor has been an issue. I think that there's a scarcity of the labor pool, and I think until the benefits stop, until the support that the government has rightly been giving to everybody, people will have to go back to work, and they will soon.
Well, it's interesting that you say that, because when we look at the labor statistics, you know, at those monthly jobs reports and job numbers, it tends to be the hospitality industry where you are seeing the big moves up in terms of hiring. So, you know, I do wonder, you know, whether or not it really is benefits that are holding people back. It does look like a lot of people who work in that industry are coming back, but you're saying that's not the case.
Well, they're not coming back yet. We can't keep pace with the demand.
Okay.
The demand is out there, but the labor supply is very, very restricted. And I think, you know, you have to remember the hotel industry shut down a year ago.
Right.
And so everybody was kind of laid off and not working. So they were building on a base of zero. So that's why they may be having bigger employment gains. But, you know, the labor pool, there's a real shortage here. And I don't look at it as a paradigm shift. You know, I think, but there is a labor shortage. And I think restaurants can't even open yet because they can't find the labor.
So are you having to pay more, Ian, to get workers to come back? Is that something that's actually helping you get workers, the needed workers that are necessary?
We are offering higher pay, but it's not always very convincing. You know, people are able to insist on the benefits that they have received and are continuing to receive. And when the minute that completely diminishes, people will be obliged to come back to work. Period. It's kind of very simple as far as I'm concerned.
Well, is that inability to get the workers maybe you need, is that slowing your ability to come back as strongly as you would like? Is that holding you back in terms of meeting the demand at your properties?
Yes, it is. We have to restrict. Like we have a lot of new restaurants in Columbus, and like we had an opening last night. I couldn't do the normal opening that I usually do, which is like a Day of the Locust. You know, I had to be restricted because we didn't have the staff to be able to execute as well as we want to execute. So we had to cut back. And we had to come up with a new playbook. And I think restaurants throughout New York, I know, are having to be restrictive on how fast it can open.
All right, sit tight for a second, Ian. We're going to do a little bit of news, but we'll come back and continue with you. We're talking right now with Ian Schrager, hotelier, founder, chairman of the Ian Schrager Company. We'll continue. I want to hear a little bit, too, about his reboot of his hotel, the Public brand, and we'll get into that in just a moment. Just a reminder of how markets closed on this Fed Wednesday. It was a big day. Investors certainly been counting down to it. The Dow Jones Industrial Average off 265 points, S&P a decline of nearly 23, and the NASDAQ a loss of 33 points. All right, let's get that update on world and national news. Off to 99.1 Newsroom in the nation's capital, and Nancy Lyons. Hey, Nance.
Hey, Carol. President Biden says he took up a wide range of issues in his nearly 3-hour summit today with Russian President Vladimir Putin. Human rights were front and center, with Biden saying if Russian opposition leader Alexei Navalny dies in prison, it'll be devastating for Russia. He also brought up cyber attacks that are believed to have originated in Russia.
I pointed out to him we have significant cyber capability, and he knows it. He doesn't know exactly what it is, but it's significant. And if in fact they violate these basic norms, we will respond. Cyber. He knows.
Biden says he gave Putin a list of 16 sectors of critical infrastructure that should be off limits. Treasury Secretary Janet Yellen believes the U.S. is well on its way to a strong recovery, even if it hits a few roadblocks while getting there. She testified today before the Senate Finance Committee.
Yellen stuck to her view that the recent spike in inflation would moderate when the suddenly opened economy returns to an even keel.
We are monitoring inflation very carefully and do take it very seriously. The current burst of inflation we've seen reflects huge swings in spending patterns and is experiencing bottlenecks.
Yellen also said she's pressing governments that enacted taxes on digital commerce, which she agreed discriminate against U.S. tech firms, to reverse course, with the administration ready to impose penalties on those who don't. In Washington, Irv Chapman, Bloomberg Radio.
Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
All right, Nance, thank you so much. Joining me once again is Charlie Pellet. Charlie, a couple stories we wanted to get to, both, though, from Dow Jones, the Wall Street Journal. One has to do with New York City specifically, and I'm just talking about the city and the hospitality industry with Ian Schrager. We'll get back to him in just a moment. But the New York City Council is set to approve legislation tomorrow that provides relief for small businesses, including easing code enforcement and slashing the cost of thousands of fines at mom-and-pop shops and restaurateurs were issued in the past 8 years.
Indeed. It can be tough for a lot of those mom-and-pop stores. It will also give a reduction, a discount of 25% for all other unpaid city code violations dating back 8 years. Any accrued interest or similar late fees would be waived, so it gives the city an opportunity to generate some revenue, while at the same time giving a small break to small businesses.
Right, and just provide an assist, if you will, for an industry that has been hit really, really hard. The other story that we wanted to bring to everybody's attention, also from Dow Jones, just talks about people are running to restaurants. I've been to more restaurants than I have in the past year, in the last month. So people are returning to restaurants, stores, and hotels, but not yet the office.
Indeed. It feels good to go out to restaurants again. But I got to tell you, one change that I've noticed during the pandemic, during the lockdown, when they had limited capacity, and that is you now have to scan the restaurant, scan the menu on your phone. And while that's an important technological development, I like going through pages on a menu to see what they have. I like hearing from the waiter or waitress, the server. And I was in a restaurant the other night where basically what you did was you texted your order to the server and then you got your bill that way. So there was virtually no interaction with a human being in a restaurant, which at the end of the day, isn't it all about hospitality and humans?
I think so, and I'm guessing that our guest, Ian Schrager, would concur. So we're going to talk to him, and we're going to talk to him about the role of technology and everything. All right, Charlie, thank you. I do want to mention a headline: the CureVac messenger RNA COVID shot falling short, interim trial efficacy 47%, stock down 21% in the after hours.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. CureVac ADRs plunging after hours, now down by 47%. CureVac says its COVID-19 vaccine was 47% effective, falling well short of the high bar set by other messenger RNA shots in a preliminary analysis of a large study muddied by the spread of various virus variants. Right now, we've got shares of CureVac plunging again, down by 48%. Turned out to be a down day on Wall Street. Stocks fell, yields jumped after the Fed boosts its outlook. We had the S&P 500 index tumbling 22 points, ending the session at 42.23, down 0.5%. Fed officials signaled they'll begin dialing back the stimulus that has fueled the recovery from the pandemic. 10-year yield 1.57%. The Dow down 265, down 0.8%. Nasdaq down 33, a drop of 0.2%. Gold down 2.4%, plunging $44 the ounce, $18.14 on gold. West Texas Intermediate crude down 43 cents a barrel, 71.68, drop there of 0.6%. Again, CureVac ADRs after hours, now down by 49%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. I want to get back to Ian Schrager, hotelier and founder and chairman of the Ian Schrager Company. You know, the public brand, he created it. He's still with us on the phone in New York City. Ian, what do you want our audience, what do you want the world at large to kind of understand when it comes to the hotel and hospitality industry right now after the 12, 13, 14, 15 months that we've just endured?
I think the industry is alive and well. It took a real shock. It shut down for almost a year. There was tough. We had to survive a lot of shocks. There were taking care of your employees and fulfilling your financial responsibilities and obligations. But I think it is alive and well, and it is coming back. And it'll come back as strong as it ever was. And what I think is that every time we go through a recession, we always recover and we always exceed the previous highs that we've had. And I expect the same to happen now.
And sometimes we learn a few things along the way. And I do wonder, the past year, we've all done a lot of soul searching and maybe rethinking. And you've done a little bit of a reboot on public. Tell us what's changed.
Well, I would love to respond to what Charlie just said about going into the restaurant and ordering over your iPhone and doing all the other things by taking advantage of the recent technology advancements. It's so funny that, people always have a resistance to progress and trying something new. And I think one of the funny results of the pandemic is that because of your health concerns, people became more open to technology and using it in an effort to stay healthy and avoid contact and so on and so forth. But I just wonder, it takes people a while to get used to new things, but you don't mind getting your directions over your iPhone rather than asking somebody personally. You don't mind ordering things over Amazon rather than dealing with a personal salesperson. You don't mind getting into self-driving cars, et cetera.
Right. We order takeout, right? We do menus for takeout constantly.
Exactly. I think that's progress, and I think everything that technology can do to make it either cheaper or make it even quicker and easier for you is a good thing. And I think the hotels are going to be taking advantage of that. And that's the very heart of what public is about in luxury for all. It's kind of combining the select service, ferocious exercise and execution, and providing value with the magical luxury experience to create a new genre, which is public.
Well, and listen, you have constantly rethought about what somebody who stays at a hotel? What's the experience they want? What do they want? What, amenities are pointless? What doesn't matter anymore? What's the rethink in addition to, is it all about technology just kind of having a bigger role, whether it's opening your room or ordering food or what have you? Is that the real big difference and takeaway from the past year?
Well, it's luxury needs an update. It needs a revision. There is a lot more access to wealth than had been in prior years. We've been dealing with the same criteria for luxury for the last few hundred years, and it needs to be updated the way everything else needs to be updated. People just don't care about the same things they cared about today, and it's the same. The ultimate luxury to me is freedom of time, being treated with dignity and humanity, and getting what's important, and not having your coffee served in fine bone china by a guy in white gloves and gold buttons, and waiting 45 minutes for a breakfast delivery and paying $35 for a pot of coffee. That's not luxury to me. That's pretension. And so I think we've stripped down and gotten rid of all those things that people don't care about and just focused on making them feel good. Because luxury is a state of mind. It's not a price point. Or something that was in the past.
It's good to hear you say that, Ian, because I do think from some of the conversations that we've had over the last year, especially people in the restaurant space who saw their workers, a lot of them don't make a lot of money, who were just struggling to get by, really rethink about their model, especially some of the higher end restaurants and places. And I do wonder, the inequalities, the inequities that have been shown again, not new, but we saw them again big time over the past year, how that has kind of invaded your psyche once again.
Well, it has. I mean, you can't have half the people in this country being upset and aggravated while the other half is not. There's something wrong about that. So we have to rethink the way we're doing things, and we have to provide access to the system and access to the benefits of the system, to everybody. It has to be more egalitarian. It has to be more democratized. And I think that's a problem with business, and that's also a problem with society. And I think we're just responding. We don't make the rules. We just respond to what we think is going on. And there's no reason you can't provide value to people without dumbing down the product and providing less. There's no reason you can't have just as good a product, just as sophisticated, for less. And I think that's a new way of looking at things.
Well said, well said. And if I may, just to end on kind of a lighter note, my understanding is you, Public, actually hosted a party for Elon Musk and his guests. I think you opened up Public for the first time in 14 months for his after party when he was on Saturday Night Live. It sounds like it was a pretty wild party. A cryptocurrency theme. I think I heard Dogecoin, cookies and cupcakes. Yeah?
Yeah, we love it. We love Elon Musk. We love everything he stands for. We love his inventiveness, his innovativeness. We think he's having a positive effect on society as a whole. So we were closed. We opened up just for him because it was a thrill for us to have him and all his guests there that night. And so it was a favorite of ours. It was a thrill for us, and we're happy to do it.
Well, and we're always happy to have you on and just to get us up to speed and talk to us about the realities of what's happening. And it's good to hear that things are coming back because I know it's been really tough. Ian, be well. Ian Schrager.
Thank you, and same to you. Thank you for having me.
You bet. Always. Founder and chairman of the Ian Schrager Company on the phone in New York City. All right, coming up next, we're going to talk all things DC. Joe Matthew and Sound On and the team coming up. What do you got on your plate, Joe?
Well, there were no Dogecoin cookies today in Geneva, I'll put it that way. And they didn't even serve lunch for that matter. But we're going to bring you behind the scenes. We're going to talk about the news that was actually made, not just the fanfare that surrounded the event. Biden and Putin. Craig Gordon, our bureau chief here in Washington, D.C., will join us next in Sound On.
All right, great stuff. Looking forward to it. Joe Matthew and the gang coming up on Sound On, really talking all things, not only U.S. domestic politics, but of course, geopolitics because of that meeting between Biden and Putin. All right, that's going to do it for the Wednesday edition of Bloomberg Business Week. I'm Carol Masser for Tim Stanovic and the whole team. Have a great evening.
Innovation, money, and power collide. In Silicon Valley and beyond, this is Bloomberg Technology with Emily Chang.
I'm Emily Chang in San Francisco, and this is Bloomberg Technology. Coming up in the next hour, Presidents Biden and Putin meet in Geneva. The U.S. president says he warned his Russian counterpart against more cyber attacks on American infrastructure. We will have all the details and reaction from diplomatic and cyber experts. Plus, it's like walking into a dream. That description from the executive behind the new Google store in New York, set to open Thursday. We'll talk about the company's brick-and-mortar approach to selling more hardware and how it compares to Apple. And crypto is the next internet-sized opportunity for the United States. That nugget, plus many more from my latest Studio 1.0 with Coinbase co-founder Fred Ursum, now running the crypto investment firm Paradigm. We'll show you a preview. Those stories in a moment, but first, the U.S. market's digesting the latest Fed decision. Our Ed Ludlow has the latest. Ed, walk us through the decision and what it all means.
Yeah, a warning from Fed Chair Jay Powell that the dots should be taken with, quote, a big grain of salt. After the dot plot did show 2 quarter basis point rise by the end of 2023. And the S&P 500, the main gauge of U.S. equities, falling by the most since March, in a month, but pairing some of those losses to close down 0.5%. The tech-heavy NASDAQ 100 also paired some of the losses that we saw in the wake of that Fed decision, led by names like Apple, Amazon, Tesla, that made actually pretty significant gains through Wednesday afternoon. The benchmark U.S. 10-year Treasury yield rising by 8 basis points. You can see the yield around 1.57%. And that move actually, the biggest move in yields on a closing basis for the 10-year since March the 12th, the Bloomberg Dollar Spot Index also seeing significant gains, the most since June of last year, up 1%, closing up around 0.8%. Really, the most impact was felt in the belly of the yield curve. This is the yield on the US 5-year Treasury. You can see rising by more than 10 basis points following that Fed decision with a yield of 0.89%. This is where the market will see the most impact as well in terms of tapering. And there were some other asset classes I was looking at as well. Gold having a pretty interesting drop to a 4-week low. We know, of course, that the pathway for rate increases has been a topic of debate for the metals market. What was interesting, though, where there was less pronounced move, the crypto markets. Not much movement in Bitcoin. We saw the Bloomberg Galaxy Crypto Index already lower for most of Wednesday, not make any marked moves. And it's interesting to see the interplay between traditional assets and cryptocurrencies on a day where I know we're going to talk about it on the show. Emily.
Absolutely. Our Ed Ludlow. Ed, thanks so much for the roundup. Really important decision today. I do want to get now to the top story that Bloomberg has been all over all day. President Biden summit with the Russian President Vladimir Putin. Human rights, cybersecurity, nuclear weapons, all big topics that were discussed. Bloomberg's Maria Tadeo has the latest from Geneva. So Maria, walk us through the big takeaways so far. I know there are conflicting opinions about how much progress was made.
Yeah, look, and to go into this meeting, you have to factor and set the scene. You know, the expectations going into this were very, very low. You know, the two sides, both the United States and Russia, had said that the relationship was the lowest that it's been since the Cold War. So the expectations were very low. Now, coming out of this meeting, the two did agree to reinstate their ambassadors. That, as you know, in the diplomatic world and the world of politics, the diplomatic circles is seen as a sign of goodwill. It means that the two want to work together. And they also said there are areas in which they could see some common ground. They also said the talks were very frank and they were open, and to some extent they could help bridge some of those big differences. Now, what you do have to factor here, of course, is that the expectations were very low. And when you listen to that speech from Vladimir Putin coming out of this meeting, he was sticking very much to what is a standard Russian line, saying anything that we're accused of, the United States does it too when it comes to Alexei Navalny. As you know, that is the opposition to Putin, who was poisoned, and he was taken to Germany for treatment and then arrested as soon as he got back to Russia. He said that this was an internal matter and he would not go further than that. And of course, when you look at cybersecurity, which was something that for the U.S. delegation is key, you know, this affects the politics, but it also affects some of the companies and the corporates. You know, Vladimir Putin said, we're not responsible for this. A lot of the cyber attacks that we see are actually happening from the U.S. They come from the United States of America. So again, the breakthrough, I would argue, not a lot, but the goal here was to avoid an escalation in that very tense relationship, and to some extent, that is exactly what we got.
All right, Bloomberg's Maria Tadeo on the ground in Geneva. We've been watching your reporting all day. Maria, thank you so much for bringing the highlights to us. I want to get to someone now who has experience working with Russia and engaging with Putin directly. I want to bring in former U.S. ambassador to Russia from 2014 to 2017, John Teff. John, thank you so much for joining us. So from what Maria said there, from what you've seen and heard about this meeting, was it a success or not?
Well, I think it's too early to say, Emily. I think what the president was trying to do was to lay a base here. He was trying to establish a diplomatic framework with which to deal with the Russians. I think the president made it pretty clear. He's pretty skeptical. He spoke candidly, as he told us, to Putin about a whole array of issues, some of which you've mentioned. But I think we're not going to know, as he said, for 3 to 6 months. What you saw today was a carefully scripted diplomatic strategy, which started last week with the G7 summit, continued through the NATO summit, the EU meetings, and then culminated today with the hope that perhaps there'll be something there. I was encouraged to see that they've got a group meeting on cyber. Obviously, no guarantees there. And it's pretty clear that from the conversations or from the statements that both of the presidents made in their press conferences, that there were some pretty tough words exchanged. That said, it was businesslike. Putin called it effective, constructive. And so I think we'll just have to see. It's too early to say how much success we'll have. Last point is that I think there's a lot of problems that obviously exist in the relationship. They're based on really different views, different interests, and obviously different values. We haven't seen Putin change much. In fact, he's gotten more repressive over the last year than he was before. So we should be skeptical. We should be careful and watch. But I think our president put it down as clearly as he could today, what the stakes are, and opened up possibilities for doing things that where we might have some mutual interest.
I want to talk about cyber specifically because this is happening against the backdrop of cyber attacks that have ratcheted up in severity over especially the last 6 months. We've interviewed expert after expert who has told us these attacks are coming from Russia. Russia is doing nothing to stop it. Do you expect to see any change in the pace of those attacks, the severity of those attacks as a result of what happened today, or not?
I think we can hope so. I think at one point in the several interviews that he had, that our president had after the meeting and after his own press conference, he said that he made it clear to Putin that the United States has cyber capabilities as well. And I think Putin clearly understands that. Now, there was no threats, and President Biden went out of his way to say he was not going to be threatening. But, the Russians understand that we have considerable cyber capabilities as well. Now, I'd like to think and hope that Putin will pick up the opportunity to look at these 16 areas which Biden proposed that we put out of bounds. But, there's no evidence to date that we should be overly optimistic, put it that way.
The U.S. cyber capabilities, does that mean that our offense is at the same level of their offense? Are we unleashing the same kind of attacks that the Russians seem to be unleashing on U.S. infrastructure, or is there a different state of play?
I don't know the answer to that question. Our cyber capabilities are something that are carefully monitored, and I am certainly not privy to those kind of things. What I read in the newspapers, just like you and your viewers read in the newspapers, is that we have considerable capabilities. Now, whether we would use those kinds of things, I just don't know. There have been stories that during the Trump administration, there were some use of cyber to send messages, in effect, to the Russians, but I have no inside knowledge on that.
Well, we're going to dive into that topic specifically with a former State Department and FBI expert later this hour. Meantime, John, what do you think the main value of this meeting is? And if there is progress, is this something that we could see in a matter of months? Is this something that will play out over years?
Emily, I think it's important that we look at this meeting as an attempt to put down a base, to put down a set of understandings, and also an effort by President Biden, and I'm sure Putin on his side, to put down clear markers. People talk a lot about deadlines, but I think this is, in my experience, these summits are not just to sign agreements and are not just to come up with deliverables, as the State Department always calls them. But this was a chance for the two men, with their closest advisors, to sit down and review the bidding. And Biden hasn't been in power, obviously, since he left as vice president, and there's been a lot of things that have happened. So I, for one, am happy to see them sitting down and talking and communicating, hopefully setting up some additional meetings. But again, I'm as skeptical and careful about making any predictions. A lot depends on Putin now, but I think he understands better, going back to Moscow tonight, where Joe Biden stands on a whole array of these issues.
Right, and President Biden said earlier he is realistic, but also that a level of optimism was necessary and healthy. John Taft, former U.S. ambassador to Russia. John, thank you so much for joining us. Really appreciate your perspective here. Meantime, a U.S. lawmaker says proposed new antitrust legislation would ban Apple from pre-installing apps on its devices. Democratic Representative David Cicilline says tech companies would be prohibited from giving an advantage to their own products under his plan. This means that Apple couldn't ship an iPhone or an iPad with pre-installed apps on its iOS operating system. The proposal is part of a package of bipartisan bills that would impose significant new constraints on how tech companies operate. All right, coming up, Zuck got chucked off the annual Glassdoor top CEO list. That is why the leader of Facebook didn't make it to the list for the first time in 8 years. That is next. This is Bloomberg. Since 2013, Facebook's Mark Zuckerberg failed to make it to Glassdoor's top CEO list. Glassdoor surveyed more than 700 Facebook employees between May 2020 and May of this year, and worker sentiment about Zuckerberg has declined significantly in that time, specifically in the last few months of 2020. Could it be due to Facebook's handling of the U.S. presidential election or misinformation around the COVID-19 pandemic? Glassdoor chief economist Andrew Chamberlain joins us now with more. So when it comes to Mark Zuckerberg, Andrew, what is the data telling you? What are workers saying?
It wasn't that long ago when Mark Zuckerberg was named #1 on this list of top CEOs from Glassdoor. That was 2013. He subsequently dropped into the 50s. And for the first time ever, he's dropped completely off the list this year. And basically what we found is that the relentless public scrutiny of Facebook's product and algorithms combined with the election events of the past year, and it's just taken a toll. And normally what we find is when a company faces bad publicity, like Facebook has, internally employees rise to the occasion. It often galvanizes them to fix the problem and brings them together, and sentiment goes up. But it's just been so relentless with Facebook, especially after the January 6th Capitol insurrection, that it seems to have finally pushed Mark Zuckerberg off the list this year.
Interesting. We'll have to see what happens next year. #1 on the list was Rich Lesser of BCG. #2, and the top tech CEO on the list, was Adobe's Shantanu Narayan. What stands out about him?
So both Rich Lesser from Boston Consulting Group and Adobe, they have 99% approval ratings. Employees love them. In the case of Shantanu Narayan, people view him as putting employee health and safety first during the pandemic. Also, it's worth noting, a bunch of the tech companies that made the list this year, they are platforms like Slack, Adobe, Zoom, that have become essential during the work from home environment. And so I think that has played a role as Shantanu Narayan has really stepped out front and led the way, turning their product into like an essential thing that's kept teams remotely working, not just another product.
Microsoft Satya Nadella, #6, not bad. Tim Cook, #32. He's the only CEO to be on the list for all 8 years. Talk to us about what's important here, what workers are telling you in the data as these companies like Microsoft, like Apple, like Adobe decide their return to work plans, and workers are going through another major transition.
Yes, the common themes that unite all the winners are, first, a person that embodies a company's mission and really walks the talk of the company. Second is they practice transparent, consistent communication. They're in touch all the time, especially during times of uncertainty like this past pandemic year. And third, they're accessible and visible, as are their senior leaders. However, there's a fourth factor that really popped up this year, which was trust. Many people mentioned trust in these reviews of CEOs, and the CEOs putting employees first when they figured out how to navigate a recession and recovery. So I think that those are important lessons that we can learn from many of the leaders. And it's worth noting, although Mark Zuckerberg didn't make the list this year, no other social media CEO made the list either. So I think it's a sign of tumult during these difficult times that we didn't see any of them.
Well, and I should point out that Mark Zuckerberg still has an above average approval rating. Based on your numbers, 88% approval, yes. Average is 73%. But I wonder what somebody like Mark Zuckerberg or any of these leaders could take away from your findings here. As they decide their return to work plans, is there one right way? Are workers calling and asking for flexibility or more understanding? And if there is a, forced return to the office, does that mean these companies will lose people, or is there a vast contingent of people that want to go back to the office and have that in-person interaction?
These leaders we name are the best of the best according to employees. So these 100 leaders really are the ones to watch if you're trying to figure out what the post-COVID workplace is going to look like. Our research shows people generally want flexibility, no question. It's just an issue of how much flexibility is compatible with making sure teams work together and still get their jobs done. One interesting finding is that many of the CEOs we named on this top award are not in New York and San Francisco or Chicago. They are spread out. There were 7 CEOs in Texas, 4 in Wisconsin, 3 in Florida, 3 in Utah. So if those CEOs lead the way by locating outside of the big metro areas, it may be a sign of the times that more flexibility, more work from home and remote work might be here to stay.
Interesting. Well, talent is everywhere as well. Andrew Chamberlain of Glassdoor. Fascinating to see the list shift from year to year. Thanks for bringing it to us. Meantime, Alphabet's self-driving car unit Waymo has raised $2.5 billion in a recent funding round. Among the investors, Andreessen Horowitz and the Canada Pension Plan. Questions have been raised about the unit's strategy and its competitive strength after losing 6 key executives since February, including the CEO and the CFO. Coming up, Google wants in on brick and mortar. The company cuts its first storefront ribbon Thursday, just a few blocks from Apple's New York City store. We're going to have all the details next. And as we head to break, Roblox took a tumble Wednesday. The video game company reporting a decline in bookings for the month of May compared to the previous month. Some analysts say it was worse than anticipated, but expect the numbers to get better in June. This is Bloomberg. Microsoft is edging towards a $2 billion valuation. Based on the company's outstanding shares, it'll hit that milestone when the stock reaches $265.55. It'll hit a high of a little over $260 during Wednesday trade. Apple remains the only company to sit comfortably above the $2 billion mark. And watch out, Apple. Well, maybe. Google is coming for your New York territory. Google will open its first retail store in Manhattan, highlighting the internet giant's effort to promote its consumer hardware devices. The store in Manhattan's trendy Chelsea neighborhood will open to the public Thursday. Let's bring in Bloomberg Tech's Nico Grant for more. So, Nico, Ivy Ross, who runs Google's hardware design and designed this store, said it's like walking into a dream. I suppose that depends on whose dream you're in, but will it live up to those expectations?
Well, it's certainly walking into her dreams, and she helped oversee the design of the store. You know, I think a lot of consumers are used to the Apple Store's aesthetic, which is very stark and has a lot of glass, white, and silver. The Google Store, by contrast, was designed to have very muted and neutral tones. And so the furniture is made of blonde wood, and it's made of cork by local artists in New York. They wanted the products to stand out, and it really feels like a social space with sofas and coffee tables and piles of books next to a speaker so that customers can see what Google's products might look like in their home.
Okay, so aside from cushy sofas, what kind of Google products will we find in the store, and will they be enticing enough to buy?
Well, Google's hardware division, which has really been operating for 5 years now, has been fledgling to some extent. Of course, they make a lineup of phones called Pixel. They make Nest devices for the home, but they're not market leaders. They're actually far from it in both areas. And so you can buy all of those things. You can also buy third-party accessories for Google devices and Google swag, such as caps that say Google, and T-shirts and dog toys and things of that nature. And if you have Google products already and they need to be serviced, you can bring them into the store, and Google will try to fix your devices same day, as well as exposing customers to a whole bunch of other technology in certain rooms that have various experiences.
So, quick question, will it compare to the Apple Store experience? You have 30 seconds.
Well, Apple has a network, and this is just going to be a niche effort, even though it is in the middle of New York City. I think that it's going to be very interesting for Google fans and buyers and people who may have an open mind to it.
Okay, well, the beginning of something, for sure. Bloomberg's Nico Grant. Always good to have you, Nico. Thanks so much for that update. Coming up, we'll have more from the meeting of the presidents, Biden and Putin, sitting down in Geneva as hackers in Russia have ratcheted up attacks on prime U.S. targets. Will they ever end? That's next. This is Bloomberg. back to Bloomberg Technology. I'm Emily Chang in San Francisco. Let's get back to the markets where Ed Ludlow has been keeping an eye on cybersecurity stocks. Ed, take it away.
Yeah, so President Biden brought up the issue of cybersecurity around the meeting with President Putin. We also saw pretty pronounced moves in cyber stocks lower after that Fed decision, but they bounced back. You can see the NASDAQ CTA Cybersecurity Index closing up. It's actually pushing to a fresh record high. Also, the BI Cybersecurity Peers Index closing up by 0.1% or so. But what's really interesting, over the last few weeks, cybersecurity has dominated the headlines, the news cycle. But you don't really seem to see the same energy in equity markets. Here, this orange line is the NASDAQ 100, that sort of tech-heavy gauge. The white line is the NASDAQ CTA index. It's lagged behind. It's only recently that we've seen, over the last few days, gains in these cybersecurity stocks. The question is, when does investor psychology change? If you look at flows for ETFs that track cybersecurity stocks, this is actually a basket that BI, Bloomberg Intelligence, puts together. We saw outflows in April and May, but in June so far, inflows of almost $200 million. That's kind of interesting. Is it now changing that investors are taking cybersecurity more seriously? Emily.
All right, Ed, thank you. As Ed mentioned, cybersecurity top of mind. One of the most controversial topics during President Biden's meeting with Russian President Vladimir Putin. President Biden outlining certain critical infrastructure was to be, quote, off limits.
Another area we spent a great deal of time on was cyber and cybersecurity. I talked about the proposition that certain critical infrastructure should be off limits to attack, period, by cyber or any other means. I gave them a list. If I'm not mistaken, I don't have it in front of me, 16 specific entities, 16 defined as critical infrastructure under U.S. policy, from the energy sector to our water systems.
Joining me now, Chris Painter, president at the Global Commission on the Stability of Cyberspace and a former cyber diplomat. Chris, I have to say, you worked at the DOJ, the FBI, the National Security Council, the State Department, all on cyber. Do you think that the Russians will act as if anything is off limits?
Well, that's the real question. As President Biden said, the proof will be in the pudding to see if they actually obey this. So far, no. They've already agreed in the UN, for instance, that critical infrastructure, countries shouldn't attack that in peacetime, and we're in peacetime now. And yet you see these incidents all the time, both by the Russian state and also by Russian actors in Russia, cyber criminals, where they're not taking any action. So yes, it's great to agree on things, but unless there's actually follow through and accountability and consequences, I don't think we're going to see a change.
So based on what you heard out of this meeting, what could President Putin do? What will he likely do when it comes to cyberspace?
Well, I think it's good they agreed to talk, at least at some lower level basis. I think there can be some things that are at least discussed between the two sides. However, I thought that perhaps President Putin, I thought there was a glimmer of hope that he might cooperate against these cyber criminal groups because they're not operating on his behalf. Now, sometimes they do, but in this case, on these ransomware cases, they don't seem to have recently, the Colonial Pipelines and other attacks. And as a show of good faith, he could say, I'm going to crack down on them. Now, you saw at his press conference, he just denied it was ever happening at all and said that most of the cyber activity was coming from the U.S. So that certainly was not a good sign. Again, we'll see what happens in the coming weeks and months. We'll see if he actually starts doing something. As you said, I was a prosecutor for a long time. I've dealt with Russia for a long time. They've never been that cooperative on cybercrime, but they are responsible when these actors are operating from their territory and causing things like the Colonial Pipelines attack.
So let's talk about responsibility, because Colonial Pipeline, JBS, the biggest